Okay, so hello everyone. Good morning. Welcome to today's macro snapshot. We are Monday, December the 18th. Obviously, as you can see behind me, we're getting close to the holiday season, so just another few trading days. So let's see what happens to the market this week, because obviously towards the end of the week we probably will have less activity, less liquidity, maybe a general slowdown. Of course, less liquidity we know can lead to sort of sort of very tranquil markets. On the other hand, it could lead to some outsized moves. And of course, we do have the PCE, the core PCE, being released this Friday, actually on the 22nd, just before Christmas. So that could provide a little bit of interest. Okay, so I think the key thing to be looking out for here, guys, is basically what's going on with the Fed. And we all know that we had a very dovish, well, at least considered very dovish Powell, considered by the market that way. And of course, inevitably, we had a big pushback on Friday with the Fed speakers. So we had Williams coming out at 8:30 in the morning. And you can see this. I'll just sort of throw up very quickly sort of a gold chart. You get a sense here. This is just like what is this? The 5-minute chart of the gold futures, and you can see here that the market was very aggressively in a dovish way pricing Powell, but then obviously maybe I suppose Powell got on the phone to the other sort of members of the FOMC and said, "Hey, you need to push back a little bit here. The market's getting ahead of itself a little bit," and to be honest, that's going to be the huge battle and major question to try and solve, especially in the first quarter of 2024. It's pretty complex. It's difficult to hold a position because you're being whipsawed around by sort of dovishness and then hawkish pushback. And you can see here that Williams on Friday morning on a CNBC just sort of said, "Oh, we're not even talking about cuts at this point," which, by the way, is a direct contradiction of his boss, because Powell explicitly stated that they had been speaking at the FOMC meeting about the potential timing for rate cuts. And so I guess this was just a symbolic move. But you see here that Williams here caused, for example, gold to come down, then it sort of came back, and then in the afternoon we also have Bostich doubling down, and Goolsby to a certain extent as well. So the real question here, which is going to be very interesting, is does the market just take this as sort of mere rhetoric and say that the blah blah blah? The reality is they are talking about rate cuts. They have stopped hiking, and it is a dovish sort of I don't know if we can say a full pivot, but definitely a sort of a pause. And we'll see. So obviously this sort of price action here in the bonds, sorry, in gold was also echoed by the bonds. And if we look at something like, let's say, the 2-year yield, you can see here how on Friday morning, basically it spiked a little bit and then calmed down, and then we have Bostich. So again, we have this, but again, that's in the context of the this is, let's just put this all in context, is that this is Powell and the FOMC on Wednesday, and you can see here it fell, the 2-year yield fell down 30-40 basis points or so, and so a little bit of a pushback is maybe not such a not to be unexpected. And really the question here is, does the market believe it? I mean, you could do this kind of, very rough crayons here and say that, is this just some kind of, sort of bear flag, so to speak, on the yields, and that actually the yields will sort of continue falling. We shall have to see. Now, basically today we do have a few Fed members speaking. I think we have Williams again. Let me just double check. So let's just have a quick look here. It's because this is going to, I think, especially this week, this will sort of move the market a little bit. I think gradually over time, what's going to happen is that it's going to be all about the data. So I think that what's going to happen is that the rhetoric will become less and less important, and it's going to be much more about the data. Is the data going to support, sort of a dovish Fed, or is the data not going to do that? And as you guys can see here, just looking today on the 18th, we have Goolsby on CNBC. And I guess looks like we have Bostich and Goolsby speaking. Seems to be a lot of Goolsby speaking a lot this week. So let's just see what happens there. But I think over time that'll fade, and everyone's just going to sort of basically focus on the data. And speaking about data, let's just have a look and see what we have. We don't have a huge amount. I mean, at this point, we have what's this New York Fed Services business activity. And if you guys will remember, going back to last Friday, we had the PMIs, the S&P Global PMIs, which were relatively soft, not crazily weak, but relatively soft. And we also had the Empire Manufacturing, which was pretty soft. From memory, it was -14 or -15, something like that. So the point is that it does seem to be that the economy is doing okay, but very, very, very softly deflating. The labor market seems to be relatively robust, but here and there little cracks are appearing. And it does seem the third thing is that inflation is generally sort of floating downwards, not coming down super, super fast, and that the core inflation is remaining a little bit sticky. So the real question here is that, will the Fed in 2024 basically say, well, you can either have a 2% inflation, markets or the public, but we're going to have a bit of nasty unemployment, or do we do like a 2.5, 2.75, 3% inflation with a strong economy? And it was interesting to me that in Powell's press conference, he sort of said something to the effect that the dual mandate, the risks were coming back towards looking after the employment mandate. So it was almost as though he was saying, hey, we have two mandates. We've been extremely focused on inflation for, let's say, 18 months. It's also time to consider the situation with the employment mandate. And I personally believe that what he was trying to communicate, and I may be wrong, of course, but what I personally believe is that he was trying to say that the price to pay for a strong economy and a strong labor market and low unemployment was, maybe 2.5, 2.75 inflation, and that was a reasonable trade-off. Of course, a lot of people are saying that this is going to be broadly supportive. It's political. It's a little bit anti-Trump. It's a little bit pro-Biden. That Yellen at the Treasury is working in cahoots with Powell at the Fed. We shall see. I don't think it's useful to speculate about that kind of stuff. The other issues to keep on thinking about as we come into the first quarter and we get it to the end of the year is that we do have some risk events at the end of January. I think on like January the 31st, we do have the quarterly refunding announcement again. That's gone off the radar a little bit, but we do have a quarterly refunding announcement where there is a risk that the long-term bonds will be issued in greater size than expected, and that could cause the long end yields to spike up a little bit as well. Anyway, that's probably a question, as we say, for the next few weeks. So just this week, we don't have a huge amount of data. We have some housing data. What could be interesting, especially in thin markets, could be the Conference Board consumer confidence and expectations. If that stays strong, that will presumably cause the market to push back so a little bit against the dovishness of Powell. And then, of course, we have on Thursday, we have a third reading, the final reading of the GDP. That shouldn't change too much, but probably the most important one is going to be on Friday. Just literally just before the markets close, we're going to have the PCE, core PCE for November, which is going to be interesting. If that number is hot, the markets will definitely react to that. On the other hand, of course, it is expected to be relatively soft. We've had these sort of low gasoline prices, low energy prices, so that would be a bit of a shock if that were to be higher than expected. But that would certainly cause a market reaction. So just in terms of where we are, it's just interesting to sort of have a look and say, well, what I'm looking at, which I think is kind of instructive, is just to see what the market is pricing. And the market is pricing, like 5 or 6 cuts. And essentially, I think what the Fed was trying to say, well, the pushback on Friday was to say, hey, market, maybe we're going to get 2 or 3 cuts, but, maybe 5 or 6 is getting a little bit aggressive. And we've seen this sort of play out, this narrative play out here in this chart. Now, what this chart is the number of basis points on the right, which are priced into the March meeting. And now the March meeting seems to be the one around which there's quite a lot of debate at the moment. A lot of people are saying that, maybe in June, maybe May, June, the Fed might go and actually start cutting, or at least signaling that. March is still, up for grabs. And what you can see here is that this is the Fed meeting 2 p.m. on Wednesday. And you can see at that point, we had about a 50% chance of a cut priced in, which is 12 basis points, 12.5 basis points. And you can see that, once we got the summary of economic projections, which was showing that lower sort of rate of Fed funds rate, and then Powell's presser, we see that press conference, we see that, the market very, very dovishly priced down to almost, what's that, like 25, what was the low there? About 28 basis points, so a full cut. So then it sort of drifted up a little bit. And then as you guys can see, we had a bit of a pushback here. This is the pushback on Friday morning from Williams, just going up a couple of basis points, and then Bostich. So essentially at this point, we've got to the point where, pre-Powell, we had about 12 basis points. Now we're at about 20. So the market seems to be settling into this range here, where it could push down to a full, a cut priced in, or maybe even come back a little bit. And I expect that's going to be the story of the next few weeks. Keep in mind that the Fed is next meeting, I believe, on the 31st of January. I'd have to check that, but late January, around when the QRA is happening as well. So that's going to be a very interesting few days. But basically here we've got, this is probably going to sort of just pop up and down, just depending on the data and on inflation data. We're going to have another CPI print, of course. So that's something there. The other thing which is kind of interesting is look at the short-term interest rates, which again did sort of get in a certain sense, ahead of themselves. And what we're showing here is the short-term interest rates, the SOFR contracts, and the implied yields. And what you can see is that where are we? So this is today. Let me just have a look here. Sorry, I just did it a couple of minutes ago. So we have here the green one is essentially on the 11th. So this is before Powell, going back about a week or so. And you can see that this is the brown line here is the number where we are at market close on Friday. And obviously what you can see is that there's been a repricing in dovishly. So this is the yields have been repriced down lower. And you can see the differentials here. You can see that really a lot of the energy was not so much, in the very, very short term, really in that, sort of mid to, sort of Q2, Q3, Q4 of 2024 here. You can see that we had, up to 20 over 30 basis points of dovish repricing here. And so we're now at a point that if we actually just look and see what's priced in for until the end of the year, you can see that we have a terminal rate of about 530, which is basically sort of now January, and that by the end of the year, it goes down to about 387. So that's about what is that? Well, here we go. Here, make it life easier. Almost 6 cuts priced in. And so really some people are saying, and I think we're at a situation here where either to justify this pricing, by which I mean, 5 or 6 cuts in the next 12 months, we probably need a pretty nasty recession, a fairly strong recession, which will cause the Fed actually to cut by, sort of 150, 200, 225 basis points. On the other hand, if we don't have a nasty recession and we have the famous soft landing where, the unemployment rate maybe drifts up to 3.8, 3.94, the economy just softens a little bit, but we don't really have a full-blown recession, then, a lot of people are saying that, hey, this sort of 6 cuts is way too dovish, and that if anything, that needs to be sort of taken out. So I think where it could be interesting in terms of trading opportunities as well is going to be maybe some of the short-term interest rates, like the STIR products, like the SOFRs, December 24. That's probably going to be a relatively volatile sort of product, because that's going to be sort of zipping up and down depending on inflation data, Fed speak, and also the real economy. The issue there is how does one actually hold those kind of trades, because on any given data point, the market seems to be moving up and down. It's pretty volatile. It's moving up 20 or 30 basis points. And that's going to be, that's difficult to hold through. Just something interesting I came across this morning on the Daily Shot. It's just this whole sort of analysis of when does the Fed actually cut. And you can see here, this is what they're saying, the time elapsed. So the total time which passes. Oops, let me just try and make this a bit bigger. There we go. Hopefully that's easier. So the total time elapsed between the last rate hike in respective cycle and the first cut. So basically saying, so remember that the Fed hasn't hiked since I think July or so. And this is where we are now. So we're now at a point here about, what's that, 250, 275 days. So you can say that historically, if you go back in the last sort of cutting cycles, which you're looking at here, this is how long it's been like basically the Fed holding before they cut. So you can see that we're getting to a point where, it could go until 450 days. So we could have another 150 days, like 6 months or so. On the other hand, it's not nothing, like, 6 months have passed. So that's sort of, May so that March to May window is definitely a possibility, just if you look back historically. Of course, it's difficult to extrapolate from the past. Okay, so that's it, guys. Let's just have a look at a few charts here. Obviously, the big moves last week, we had huge moves in the equities. But looking at the equities, when I say huge moves, I mean, we're now getting to a point where the SPX, and I'll look at the cash, the cash chart here. So the SPX, there is still another % or two to go. So do I believe that can sort of, seasonality, Christmas time is pretty good and the holiday season is pretty good. So could that push a little bit higher? Absolutely. Could it push above? Yes. Is it time to short? It's a tricky one because there are arguments on both sides. They're both good. January is seasonally, relatively strong, and then sort of February, March, from a seasonality point of view, is historically a little bit weak. Could this be that this sort of pushes above? And as some market commentator was like to say, it's easier on the other side of the mountain. Maybe what we need to see is this to push higher, a little test, a little fall down, maybe a retest higher, then we can go lower. But again, it's going to depend on the QRA. It's going to depend on the Fed in January. So at this point, it's difficult to get long here just because we're near the high. On the other hand, there's no particular reason to be shorting. So that's interesting one there. Similar kind of situation. What I would say though, guys, which is pretty interesting, is just the outperformance of the small caps. You can see here, if we look at the Russell, it's really outperformed. And if you just look at a few ratios here, which I like to look at some of the ratios here, you can see something like let's see, like SPY versus like the small retailers. You see the SPY has absolutely massively underperformed the PSCD. If you look at something like the SPY versus the Russell, you can see the SPY is also completely underperformed. So definitely this is a good moment for the for the small caps. And what a lot of people are sort of saying is that maybe this is sort of a moment to look for laggards and sort of catch up. And it's like, well, okay, what stocks have been underloved and which sectors have been underloved. So that seems to be one of the sort of the themes going on at the moment, is this whole idea of that the Mag 7, the large caps have really outperformed over 2023. Maybe it's time to look at some of these small caps. Maybe it's time to look at sort of regional banks, companies which will perform well with a steepening yield curve. These kind of companies. So that's definitely something to be sort of doing research to over the holiday period. Just in other global equity, we see that China remains incredibly weak here, guys. And I was talking to someone over the weekend who's, about China, and for sure these prices look attractive. But the problem is, as they say, if you liked it at 10, you're going to love it at 5. And if you loved it at 5, you're going to love it at 2. At this point, there's no clear evidence that China has recovered, is recovering. There's little dribs of stimulus here and there, but if you're just looking like at the CSI 300, I mean, this is a very, very ugly chart. If you look at Chinese stocks traded on the Hong Kong, the Hang Seng index, not too bad, but you've got to be just careful, extrapolating too much from a little recovery here, because at the end of the day, there's nothing. I think it makes sense for those of you interested in China in just being a bit more patient and saying, hey, if it's going to recover, there's huge amounts of upside. So wait for evidence of a recovery and technically wait for some kind of evidence. Wait for, for a basing formation, like there's plenty of upsides. So I think now to try and be a rock star and sort of come in here very early, there is a possibility that it just keeps on sort of falling. I mean, if anything, I prefer the US markets, maybe emerging markets, excluding China and maybe Europe. Just talking about some other equities here. Sorry, other markets here. Obviously, one of the big issues is that the front end of the curve, like the ZT, the short-term bonds have done very, very well on the dovishness, but they are in danger of pulling back. And we saw on Friday with a bit of pushback, they could easily fall back a little bit here. And what we are seeing is like something like the yield curve, which I'm sort of kind of interested in, is that yes, historically the curve will steepen, and it probably will steepen in 2024. Really, what's going to be kind of probably a complex and painful trade is to try and figure that out and how to actually trade that. Because I mean, I looked at here, for example, the 2s 30s, and it's a similar chart for the 2s 10s and the 5s 30s. Is that this to me does seem to be like sort of a bullish flag, like a flagging formation. What would be a little bit of a danger side, but a possibility is if this sort of flattened a little bit more, and it absolutely could flatten a little bit more, another 5 or 10 basis points. I don't think it's going to flatten massively, just because at a certain point, the Fed will start cutting. So the problem here is that going to be in sort of February, March, or is that going to be in June, July, August? Will it be as much as the market is pricing? Will it be more than the market is pricing? And the problem now, as we saw, is that the market has already priced in between 5 and 6 cuts in 2024. So really at this point, inflation data has to surprise, I would say, to the downside, and the real economy has to surprise to the dovish, weakish side to justify market pricing. And that's why at the very front end of the curve, I think what's happening is that something like the 2 year could underperform or outperform something like the 5 year. So I'm personally looking at the 5 to 2 year spread. And just to see that, and again, you see here that that is actually, it's a flattening here a little bit, and that's bull flattening, and that's just because at the moment, market participants are saying, well, hey, the 2 year for sure, at some point the yields will come down more. They've already come down a lot, and at this point, maybe we're going to be in a holding pattern. We need to wait and see for real evidence that the Fed is actually explicitly committing to cuts, and that the market, the real economy, and that the inflation justifies such cuts. So that's why I think at the moment a lot of people are talking that the money is going to flow from the very short-term money markets, because market participants are starting to think that those highs for like 3 month highs and things like that. It makes sense to start going a bit further out the curve into the 2 year, into the 3 year, into the 4 year. And so if you like the 2 year, maybe the idea is like, hey, maybe the 3, 4, or 5 year is a better place, because you're going to lock in, relatively good returns, and it's not so dependent on the explicit path of the Fed. So just to say that the 2 year at the moment is underperforming a little bit, and we see that, if we look at the yields, we can see something like the 30-year yield just continues to really fall a lot. It's down now through the 200-day moving average. And you can see, let's say, for example, the 30-year yield is falling more than the 10, which is falling more than the 5, which is falling more from the 2. So definitely at the moment, we're getting sort of a fairly bullish, a bull flattener. And that's, depressing, let's say something like the dollar, having a bit of a bounce today. But basically the dollar, relatively weak. But again, it's relatively weak. And you have to say, it's not exactly, we had the IFO this morning coming out of Germany, which was lower than expected. So it's not as though the German economy or the European economy is booming. We had a pushback last week from the ECB and the BOE. But the reality is that, at some point the ECB will start cutting. And I can't imagine they're going to cut less than the Fed. They're trying to talk the talk a little hawkishly, but I can't imagine that their economy is going to outperform the US, and I can't imagine that their central bank, the ECB, will out-hawk the Fed. So the point is that the US dollar, I mean, it could be a little soft. It could get down, a little lower, like 101, something like that. But at the end of the day, it's not going to particularly underperform. I think it's just simply going to range at this point. Obviously, the big news is the BOJ meeting happening in the next 24 hours. It's pretty simple. Like that they could sort of dovishly just not do too much, or they could slightly tweak and sort of gently indicate in a very subtle way that they are slowly preparing the market for a little bit of a tweak to their ultra dovish policy, maybe in the January meeting. And I think it's going to be fairly binary. It's difficult to trade that. Maybe a straddle, thinking I'm going to look today, maybe some kind of straddle structure, although the implied vol will probably collapse immediately after the market. But maybe some kind of straddle structure, very simply, if they indicate that they're sort of, considering exiting their ultra dovish policy. Of course, the US dollar will weaken against the yen. On the other hand, the US dollar will strengthen against the yen if there's no sign of any sort of dovishness. So that's that. The final thing, guys, just want to have a quick look at here is maybe oil. Oil's looking interesting to me because, I mean, there's a lot of, talk about, sort of China demand coming down and the global economy slowing down for sure. But at the end of the day, we did get kind of just like a turtle head here, as they say, just like a little, sort of look below. And as you can see here, it looked below and didn't rebounded. It's also, if you look at oil, if you go on, let's say, a weekly, you can have a look and see, let's say on a like a 200-week moving average, you can see that oil did bounce off its 200-week, its very long-term 200-week moving average here. So maybe oil is turning up. The only thing I would say, though, I maybe want to have a little bit more evidence, just because, just from a technical point of view. Sorry, guys, I'm just going to clean this up here and go on to the January contract here. If you even look at this very short-term fib here, oil hasn't done much. Like, it's done something. It sort of seems to be, rejecting these lows. It's, it's been supported, as we just said, by the 200-week moving average. But at this point, at least on the January contract, from this short-term fib, it hasn't even breached the 38% fib. Ideally, I would like this to, start to chunk through to fight through some of these fib zones. But it's not really bullish, in my humble opinion, until it gets above the 61.8% fib at a minimum, which is, let's say, about 75.50. You can be a bit of a hero and get in here early, but to be honest, it's absolutely possible that this, is resisted at this 38% fib at 72.90 and comes back down. We'll see on the CL1 chart. Looks a little better. It's just sort of pushing through into the fib zone. So what I'm trying to say here, I think this is an interesting long shot. Could this push up here? Yes. Could it be rejected? Absolutely. And the other thing which I just want to draw everyone's attention to, if you look at the time spreads, and I'll finish on this. Well, here, if you look at, let's say this is the WTI time spreads, this is the live data, which is the orange. So yeah, the price has gone up a little bit compared to 1 week ago. This is from 1 week ago, the green. But look at the shape of the curve here, guys. I mean, yeah, I mean it's not bad, but really the major gains have been sort of in the middle of 2024 until the third quarter of 2024. You're talking September, October. That's where the major gains have been here. And if you look at the very front of the curve, that's from a week ago. If anything, it looks like it's in even more contango than it was a week ago. So I'm just a bit worried about oil because if you look at, as I said, the time spreads, they're not looking particularly. Certainly not bullish and not even really in recovery mode, still looking pretty weak. So I'm still not completely convinced by oil, just looking at those time spreads there. Okay, guys, I'll leave it there a bit longer, but I just want to sort of have a bit of a chat about the Fed. We'll keep on talking a little bit if there's something to say. Again, what I'll be looking at I'll be looking at oil, obviously the Bank of Japan, that could, because if they are hawkish, remember, of course, that could have implications for sort of global yields, maybe going up a little bit because the Japanese bond market is very high. We're going to have Fed speak. Let's see if they continue to push back. And what's going to be important is to see whether the market just ignores the Fed speak and says, yeah, whatever, guys, we know you're going to be dovish, or whether actually yields do start rising. And then just keeping, of course, a little eye on gold and the equities, and just see if equities keep on pushing up. We do have Nike and FedEx. So that's kind of interesting. They're reporting their earnings. So we have Nike and FedEx this week, I believe. That's going to be interesting just in terms of global, I don't want to say supply chains, but logistics. Will FedEx tell us that they're seeing plenty of demand? And also Nike, just from a term in terms of consumer discretionary demand, will they be saying there's strong demand? That's something interesting to be looking at this week is, as I say, Nike and FedEx earnings. Okay, I'll leave it there, guys. Have a great week, and we'll probably talk, if not every day, at least once or twice, just as we go into the holiday period. Thank you. Have a great day.